Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And I think this week we need to focus specifically on South Africa. Obviously, we had Moody's adjust their credit rating outlook for South Africa from neutral to positive. That's clearly encouraging. They did flag that South Africa's made headway in terms of fiscal discipline, and some of the policy reforms are obviously encouraging within the logistics sector and also within the energy space. But I think that in order to get a full credit rating upgrade, South Africa is going to have to lift the GDP growth rate, ideally to above 2%, so that we can start to improve income per capita. So I think that's a little way off, but not impossible to achieve. The data that was out last week for South Africa, two areas to focus on. Obviously, the inflation numbers for the month of April. We started to get the first of the big petrol price increases in the data, with inflation moving up to 4%. So I think we can go through that in a little bit of detail. And then the second, I think, on South Africa's retail sales data for the month of March. Still positive, but I would suggest losing some momentum. And I think it's important to explain why we are likely to see a loss of momentum within within broadly consumer spending, but specifically retail sales. So two key areas to focus on relating to South Africa. So let's start with a discussion on South Africa's inflation data for the month of April. During the month, the CPI went up 1.1%, which pushed the annual rate of inflation up to 4%. In the previous month, it was sitting at 3.1%. So a significant increase in the annual rate, taking us quite a bit away from the 3% inflation target. At a core level, inflation went up 0.5% in the month, which pushed the annual rate of core inflation up to 3.6%, you would say. Still reasonably comfortable, but the risk is clearly to the upside. And what will now concern the Reserve Bank is, does some of the fuel price increase start to feed into other categories of inflation? I would say so far, you can't really see a huge amount of evidence of that happening, but it's still very early in the process. And I've got no doubt we'll have some element of second round effects, which I think the Reserve Bank will take into account when they decide on interest rates later this week. In terms of other price increases during the month, there was a fairly sizable increase in food prices, going up 0.8% in the month. At an annual rate, food inflation is still reasonably well contained at 2.8%, but there's no doubt that the higher fuel price will generally push food prices higher through the transport cost, and so I think we can anticipate additional pressure in the months ahead. There was a further adjustment to medical aid inflation. Some of the medical aids submitted their data late, and so medical aid inflation is now sitting at around 8.5%. It was sitting at over 10%. I think it was 10.3% last year. So a slight moderation there, but high, very high at an annual rate going into the next year from here. If I look at some other factors during the month, there was a big decline in the cost of hotels, and that's quite difficult to explain other than suggesting it may have been seasonal. We know that at the beginning of the year, South Africa enjoyed record high foreign tourist numbers. That did put upward pressure on hotel costs, and we saw hotel inflation move up quite considerably, and it got to a peak of about 12% year on year, which in a sense is good news that there are foreign tourists around, but it's also obviously bad in terms of the overall impact on the inflation data. Subsequent to that, as I said, we saw hotel costs come down quite considerably during the month. If I look at the actual accommodation services category, it declined by 6.3% in the month, which has taken the annual rate down from over 12% to 7.3%. 7.3% still high when you consider we've got an inflation target of 3%, but as I say, I think it reflects the relative buoyancy of the tourism sector. The other changes, I don't think significant additional changes to mention, other than to highlight that we've got a further petrol price increase that has to come into the data next month. and that will push the annual rate of inflation closer to 5%. So clearly we're moving in the wrong direction, and the Reserve Bank will have to take that all on board when they decide on interest rates later this week. The expectation is they will hike 25 basis points, and I know many people argue that why hike 25? 25 will obviously aggravate the plight of the consumer. The consumer is already under pressure because of the higher fuel price, and that by increasing interest rates, you're not going to be able to bring down the fuel price. And that's all fair comment. The Reserve Bank, though, will be mindful of so-called second-round effects, the risk that the fuel price increase feeds into other categories of inflation. And if they don't respond, there is a real risk that inflation expectations move higher, that people take the opportunity to push on more of the fuel price increase into other prices. And before you know it, you've got broad-based inflation that is then difficult to bring under control. So the expectation is the Reserve Bank will move now rather than wait a couple of months and hike 25 basis points and send a message that they are determined to keep inflation under control, and therefore they are determined to meet their 3% inflation goal. It doesn't mean that inflation doesn't go up over the next couple of months. It certainly will. And as I say, we expect it to get closer to 5%. But hopefully beyond that, there is a resolution to the Iran conflict, a move down in the international oil price. And I think that would help enormously to start to bring inflation more under control, and therefore allow the Reserve Bank to only possibly hike rates once by 25 basis points, and then try and keep rates under control and look for an opportunity to cut rates. I think overall interest rates in South Africa are restrictive. In other words, they're higher than they ought to be. You could easily, I think, reduce our interest rates by 100 basis points from here, and they would still be appropriate. So there is scope to cut interest rates, but in the short term, I think the Reserve Bank is going to feel compelled to move rates higher in order to try and control inflation expectations and ultimately make sure that we can head back down to the 3% inflation rate. So I think overall the inflation numbers for the month of April, they were largely in line with expectations. Perhaps you could argue core inflation slightly higher, but I don't think there's anything in the data that would really be a big concern. And I think most people accept that inflation is going to move higher in the short term. The question is not that. The question is, can we control the extent of the increase, and how quickly can we bring it back down to that 3% target? Second topic is a quick discussion on South Africa's retail sales for the month of March. During the month, sales went up 0.1%, which is very modest under most circumstances. And on an annual rate, we saw retail sales increase by 2.6%. Both of those numbers have been adjusted for inflation. So you would say those were reasonably decent numbers, but not at the same pace that we've seen in the last, I would say, 15 months. If I look during the course of last year, retail sales grew by 3.7%, which is a remarkable increase. A lot of that was driven by the two-pot withdrawal in terms of pension fund savings, and also it was helped by the fact that inflation was brought systematically under control. We got the inflation rate down to 3%, which at that point was below the increase in most people's salaries. So consumers went through a phase where their disposable income rose in real terms, boosted by both salary increases being above inflation as well as the two-pot withdrawal. And clearly a lot of that two-pot withdrawal went into shopping, and hence there was a substantial buoyancy in terms of retail activity. Unfortunately, going forward, I think we're going to see retail sales dissipate. The reason is that the two-pot withdrawals are not as substantial as they've been previously. That's understandable. During the initial phase of that two-pot system, people were able to withdraw quite a bit, but they're not going to be able to withdraw the same amount in subsequent years, and that's probably a good thing in terms of preserving long-term savings, but it clearly is not going to allow for shopping activity to be quite as buoyant. And then the second factor is that We've had an increase in the fuel price, and that puts the inflation rate up closer to 5% ultimately. And at that point, the inflation rate will be above most people's salary increases, and hence we think disposable income will moderate. And as disposable income moderates, consumer spending will come under pressure. Now, some consumers have been increasing the use of credit, but I think banks are being reasonably cautious in how they grant credit. So I don't think we're going to have a huge increase in consumer credit that is going to compensate for the general pressure that household income is under. And so I think overall we're going to find that retail sales loses some momentum. I don't think we're looking at necessarily a recession in terms of retail trade. I think it still remains positive, but I just can't see that it's going to be as positive as it was last year. Now, that's not necessarily a bad thing, because it does highlight that South Africa needs to broaden out the nature of our growth dynamic. We have become very reliant on two key sectors providing most of the uplift, the one being retail sales or consumer activity, and the second being financial services. And while those two industries have outperformed, we desperately need the other key components of this economy to perform a lot better. By that I mean construction, mining activity, and manufacturing activity. And if those sectors start to perform better, then I think our overall growth rate would improve measurably. We've become too dominated by simply going shopping and banking, and we can't achieve economic success on that basis. South Africa desperately needs to broaden out the nature of the growth in order to strengthen it and therefore encourage broad-based job growth. We're not at that point yet, and the hope is that the economic reform process, the policy reform process, will take us in that direction. So I think net retail sales are going to slow. They still remain positive, but they can't be as buoyant as they were during the course of last year and into the very early part of this year. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorized financial services provider in terms of the FASE Act. Also, this podcast should not be construed as advice.